ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም።
ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ
በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ይቻላል።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና
ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና ባገኘንባቸው የፍላይት ኦፕሬሽን እና የሆስተስ ስልጠናም በምዝገባ ላይ ነን።
ጥያቄና መልስ፣ የክፍል ስራዎች ብሎም ፈተና መፈተን ክፍል ውስጥ እንዳላችሁ አይነት
ልምድ ባላቸው መምህራን እየተማራችሁ
በኦንላይን ባላችሁበት ቦታ
አድራሻ ከ22 ማዞሪያ ወደ ሾላ ገበያ በሚወስደው መንገድ 150 ሜትር ገባ ብሎ ናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
ህልሞን እውን ያደርጋል።
Today we'll start a new chapter, chapter 3, financing decisions, capital structure and the cost of capital. We'll see these concepts in this chapter: source of finance, capital structure, tiers of capital structure, and lease financing. These are the contents to be covered in this chapter. The first part of the chapter is simply descriptive, source of finance. We'll see types of instruments that we can use to access finance. Capital structure is also theoretical. Actually, in the source of finance, we'll see also cost. The cost of capital issue is quantitative. We'll see how to calculate the cost of capital. Capital structure, we'll see theories of capital structure and theories of capital structure. We'll see types of leasing, and we'll see how to decide whether leasing or loan financing is appropriate, other type of loan. We'll cover these issues in this chapter. To begin with, the first part of the chapter is with source of capital or source of finance. There are different sources of finance for companies. When we say source of finance, we're simply referring source of money for business organizations. For example, if you own a business, I hope you are familiar with basic accounting. You have to own assets. Assets must equal with liabilities plus equity. This is a basic accounting equation. Assets, all resources owned by the company. For example, if you decide where to invest or capital budgeting decision. For example, if it is the construction of a new building, that is an asset. And you need source of finance for that asset. Maybe loan, different types of loans, or maybe equity from owners. When you say loan or when you say equity, there are different types of loans, so there are different types of equities. We'll see these issues in this part. One source of finance is ordinary share or common stock, or you can call it common share. That means by issuing share to owners, we can access finance. The other one is, we'll have detailed discussion about this. The other source of finance is hybrid securities. Hybrid securities includes preference share or preferred share, warrants, convertible securities. There are types. Loan capital, maybe bank loan, maybe corporate loan. This part simply deals with liabilities. These are liabilities. These are liabilities for the company. And above, ordinary share, actually hybrid securities have the characteristics of both debt and equity, or when you say debt, we are referring liability. Don't get confused. I'm using terms interchangeably. When I say debt, I'm referring the liability of the organization. So ordinary share in Amharic, action, መደበኛ action እንለው, ordinary share or common share. By selling shares, if our company is a share company, we can get finance. And there are hybrid securities. As the name implies, they are hybrid. We'll have detailed discussion about this. And these are loan capitals. Let's see each source of finance in detail. The first one is ordinary share or common stock. If you are a business manager and if your company is a share company, to access finance, you can sell shares. You can sell shares. If you sell shares, the buyer of the share expects dividend. Share owner or shareholder expects dividend. So dividends are paid if profits are made and only after other claimants have been paid. Or in other words, after the company pays to lenders, if there is bank loan, after payment to bank loan, or if there are preference shares, after payment to preference shares, the residual balance will be paid to common shareholders or ordinary shareholders. This is one characteristic of common stock. Dividend will be paid to the shareholder after payment to debt providers and preferred shareholders. The remaining balance will be paid to common shareholders. And there's high rate of return is required because high risk for investors. Investors on common share will have high risk because their payment is after expecting payment to lenders and preferred shareholders. If the available cash is not enough to pay for lenders and preferred shareholders, there is no payment for common shareholders. They will receive the residual balance. So purchasing common share is risky, high risk and high return. As I've said in the first chapter, if there is high risk, investors expect high return. So common share is risky. The risk on common stock or common share is high. So investors on common share expect high rate of return. And when you see the other characteristics of common shareholder, it provides voting right. If we sell shares, common shares, the shareholder will have voting right. Or in other words, there will be right to vote directors, board of directors. Primitive right is also there. Common stockholders will have primitive right. That is the right to purchase additional shares before those shares are available to external investors. The right to purchase additional shares before external parties, primitive right. So common shareholders will have this right, but there is no tax benefit, unlike borrowing. That means for the company, you as a business manager, if we sell shares and get money, as then you have to pay dividend. And that dividend is not deductible from tax. The dividend will be paid after payment to the tax authority. So it's not tax deductible. So there is no tax benefit for the company. So we're seeing the characteristics of common stock. If you are an investor, if you purchase common share or common stock, you'll have periodical dividend. The risk is high because the payment is the residual balance after payment to other finance providers. If you own common share, you'll have voting right. You'll have right to purchase, the right to vote board of directors. Board of directors are agents for shareholders. If you own common share, you'll have primitive right. The right to purchase additional shares from the company. So you can think of common stock in two ways, as an investor and as a manager. So there are different risks and returns. So you have to know this. You have to know the characteristics of common stock. The other source of finance is preferred share or preferred stock. Preferred stock or preferred share. When you see the characteristics, low riskier than ordinary shares because the dividend is fixed. In case of common stock, the dividend is not fixed. It depends on the profitability and the availability of cash in the company. If there is no cash in the company, there is no payment, dividend payment for common stockholders. But preferred stockholders will receive fixed dividend regardless of the profitability and availability of cash in the company. So it is low risky for the investor. And the payment before ordinary shares in a liquidation situation. That means if the company ceases to exist, assets will be sold and finance providers will be paid. If the company ceases to exist, the company dissolves or liquidates, assets will be sold. First, debt providers will be paid, or loan providers will be paid, and then preferred shareholders will be paid, and the final recipients are common stockholders. Sorry. So the payment before ordinary share. It is one characteristic of preferred stockholders. If you purchase preferred share, your dividend will be fixed. As a manager, you will pay fixed dividend. If you purchase preferred share, the dividend payment is before common stockholders. So you will receive dividend before common stockholders. As a manager, you have to pay dividend before common stockholders. If the company liquidates, you will receive, as an investor, you will receive before common stockholders. So these are the characteristics of preferred share. And there is no voting right. Preferred shareholders have no voting right. They have no right to vote board of directors. And they are hybrid securities. Hybrid. That means their characteristics is mixed. Some of the characteristics are like equity, like common stock, that means. Some of them are like debt instrument, like bond. For example, if you purchase bond, there is, for instance, dams bond in our country. If you purchase bond, you will receive interest, fixed amount of interest, and at maturity, the principal. If you purchase preferred share, you will receive fixed amount of dividend, and if it has no maturity date, you will receive the total amount. There is no maturity date. But the dividend payment for preferred share and interest on bond are similar. They are fixed. I'm sorry. That's why we call it hybrid. Sorry. When you see the characteristics of the preferred share, the other characteristics is it is share in the first place, axiom. As a share, this characteristic is similar with common share. That's why the preferred share is a hybrid security. Some of the characteristics are debt instruments, like debt instruments. Some of them are like equity instruments. And this preferred share may be cumulative, maybe non-cumulative. Maybe cumulative, maybe non-cumulative. Cumulative preferred share, if it is cumulative, all past suspended payments, because of different reasons, for example, the company may stop payment of dividend. For example, if there is no dividend payment in this year, because there is no cash, in the coming year, this year's dividend will be added and paid to preferred shareholders. If the preferred share is with non-cumulative, as the name implies, if there is no dividend payment in this period's dividend will not be paid in the future. Non-cumulative. Actually, it depends on the agreement. Simply, here, what you have to know is preferred share maybe with cumulative or non-cumulative right. Another source of finance is loan capital, loan. Financial instruments that pay a certain rate of interest until the maturity date of the loan and then returns the principal. Loan. Bank loan maybe, or corporate bond if it is allowed. For example, in our country, public enterprises and other public entities are allowed to issue bond. For example, there is the Renaissance Dams bond. It is loan for that organization. If corporate bond is allowed in the country, corporations can issue bond and access finance. So if our company issues bond, we have to pay interest periodically, and we have to pay the principal at maturity. And interest on debt is allowed against tax. If there is loan, if our company access finance from loan, there will be periodical interest payment. That interest is expense for our company. So it will be deducted from taxable income. It will be deducted from taxable income. And another characteristic that you have to know about loan capital is seniority of debt. Seniority. For example, if there is debt before 3 years, for example, and if there is debt today, the senior debt must be paid first. The senior one must be paid first in our company. And some debts are subordinate. That means there is other main debt and there is subordinate debt. Subordinate debts will be paid after the principal or the main debt is paid. So these are these kinds of arrangements in loan financing. In the event of default, holders of subordinate debt must give preference to other specific creditors who are paid first. So if the debt is subordinate, if the company liquidates, if the company ceases to exist, subordinate debt must be paid after other debt holders, and seniority must be respected. These are additional characteristics of loan capital. So simply, here in this part, what you have to know is the characteristics of source of finance: common stock, preferred stock, loan capital. Other source of finance or other instrument that we can use to access finance is warrant. A warrant is a certificate entitling the holder to buy a specific amount of share at a specific price, or the exercise price for a given period. Actually, there will be some amount of payment to get that warrant. If there is share warrant, for example, if you purchase share warrant, that means you will have right to purchase additional shares at a certain price in the future. If the price of the share rises above the warrant, for example, if your share warrant is to purchase 1,000 shares at 500 birr, for example, let's say. If this is your agreement at a certain price on a specific date, you have right, but there is no obligation usually. For example, if the actual price in the market, the actual price of the share in the market is, let's say, 400. Are you going to exercise this? Is there anyone who can answer this? The concept is warrant means if we have share warrant, that means you have right to purchase certain amount of shares at a certain price on a specific date. Assume the amount of shares are 1,000 shares, and you agree to purchase these 1,000 shares at 500 per share. If the actual market price on that date, on the exercise date, is 400, are you going to exercise your right? This is a question. Is there anyone who can answer?
Doctor?
Yes?
Can I come in? It's Santayo.
Yes, come in.
No, I will not exercise my right. Because
why?
The market price is not going to give me a profit.
Yes, you are going to pay 500 per share, but after purchasing 500 per share, you are going to sell it at 400, so it is loss. What if the market price is 600, let's say? Another case. If the market price is 600.
Okay. The reverse will be then, ማለት ነው. I try, sir. Sorry. The reverse one. I will accept it, or I will take this decision.
That means you will purchase 1,000 shares at 500.
At 500, so that I can sell it at 600 in the market.
Yes, right. That's right. Share warrant. And usually in share warrant, if you are not going to exercise your right, it will expire automatically. It will expire. So these are kind of agreement. Another instruments in financing are convertible bonds. Actually, in our country, corporate bond is not allowed. Only government entities can issue bond. So because the financial market is not yet established, some concepts, same idea, but it is common practice in countries with financial market. I hope you have, I think you have information. There is a plan to establish financial market. Now, in the near future, we'll have and we'll apply these concepts in our country. Convertible bond, it is a type of bond having convertible characteristics. It will be convertible. It will be converted to another instrument. That means initially it is bond, for example. It can be converted into common share. And usually we use these types of instruments if the market is not enough to access finance for our projects, simply by selling common share or by selling preferred share or other types of instruments. For example, if we need, for example, 100 million for a project, the source of finance includes selling shares, if it is a share company, or bank loan, or issuing debt instrument, bond, corporate bond, for example. And investors will have different types of different preferences. Some investors prefer common stock, some investors prefer bond, corporate bond, and some investors may prefer convertible bond. So we are giving options for investors. So if we are selling convertible bond, initially it is a debt instrument. That means the buyer of that convertible bond will receive periodical interest. But after some time, it will be converted into common stock. So after some time, the bondholder will be the company owner. If it is converted into share, shareholders are owners. But if it is bond, bondholders are not owners, they are creditors. They will receive principal periodically and receive interest periodically and receive principal at maturity. They are not owners. But if the agreement is convertible, initially it is debt instrument, after some time it will be converted into equity instrument or common share. So we can issue these types of securities just to access additional finance, because investors prefer different types of instruments, because different instruments will have different risk and return. So convertible bond, a bond that can be converted into common stock after some time. And the conversion rate and other issues will be specified on the agreement. Okay, so the details will be specified in the agreement or the bond covenants. So when you see the cost of capital, we'll have detailed discussion. Simply let's see the risk. As an investor, assume you are an investor. That means buyer of share, buyer of a bond or other securities is an investor. There is expected return in the y-axis, and there is risk in the x-axis. As I have said in the first chapter, if there is increase in risk, we have to be compensated for taking that risk. So expected return must increase. And usually when you see the securities, for example, as an investor, you can invest in treasury bonds or treasury bills. For example, in our country, there is, in America, Yagimjabit Senate. I hope you are familiar with this. They are short-term securities. If you are interested to buy those securities, the risk is almost zero. Risk means deviation from the expected. And the risk is almost zero if it is treasury bill. What do you think the reason behind this is? Why the risk is almost free or zero for treasury bills? What do you think? What do you think the reason behind?
Hello,
Is
can I
my
come in,
question
doctor?
clear? Yes.
Yes. It's Sintayo again.
Okay.
Because these bills are issued by the government, and the government is respected for keeping its words, basically.
Yes. We can trust the government. You are right. And another reason is it is short term. Because if the period is long, in the long run, uncertainties are high. So uncertainty will increase in the long run. So being issued by the government and being short term makes this treasury bills risk free. And usually we consider treasury bills rate as risk free rate or opportunity cost, or in other words, a minimum return expected. For example, to invest in other areas to establish a manufacturing company or to invest in other projects, we have to set our expected return. And we have to start from the risk-free rate. The minimum return is the treasury bills rate, must be. And after that, depending on the risk level of the investment, we can add premium. The premium is compensation for taking additional risk. Now, treasury bills, the risk is low, the return is low. If it is corporate bond issued by the corporation, the risk will increase. Risk is increasing and expected return is increasing. Increase in risk, increase in expected return. Preferred share. There is increase in risk. Compared with treasury bill, corporate bond is more risky. Compared with preferred share, comparing corporate bond with preferred share is more risky. If there is increase in risk, there must be increase in return. And if it is hybrid security, the risk will increase. Increase in risk. Ordinary share, the most risky instrument. And what is the reason for this? We have discussed this. Why ordinary shares are more risky? Ordinary shares or common shares? They are risky compared with other instruments. What's the reason behind? What do you think? Anyone? Why ordinary shares or common shares are more risky compared with other instruments? Okay, Getacho, can come. I think you raised hand. Zentayo or Getacho, you can come in, one of you.
Hello?
Yes?
It's Sintayo. In my view, ordinary shares are more riskier than others because it depends on the business activity, and based on the activity, the revenue, the profit that is generated will be distributed among the shareholders. And also, before paying ordinary shareholders, other preferred shareholders and other debts should be paid for from that revenue. So it's more riskier than others.
Yes.
Thank you.
Good. Is there anyone who can add to this point? Okay, you're right. One reason is the payment is after payment to others. For example, if the company issues, actually except this treasury bill, if the company issues all these types of instruments, corporate bond, preferred share, hybrid securities, common share, Common shareholders will receive after payment to these all, these three. So if there is no cash, so if there is no residual balance, there is no payment for common shareholders. This is one. Because they receive the residual balance. And the return is variable. If there is no profit in the company, there is no payment for ordinary shareholders. So it is high risky. That's why the expected return is high. So as an investor, at the time of deciding what type of instrument to purchase, you have to know their characteristics, the risk and the return. You have to know these all. So another issue that you have to know in issuing securities is floating cost. Floating cost. Because floating cost, as a manager, if we are issuing securities, maybe corporate bond, maybe common share, preferred share, these are securities. There are floating costs. If the floating cost is high, it will reduce the company's cash. You are paying cash. So floating cost is one component at the time of deciding the source of finance because it affects the value, the cost. Accounting cost, for example. Accounting cost to issue securities, legal cost to issue securities, printing, underwriting, or investment bankers. There are many institutions that will facilitate the issuance of securities in companies, investment bankers, payment for those. And filing fees. For example, if there is a regulatory body for the financial market or regulatory body to issue securities, we have to file for that regulatory body first, and there will be fee for that. So these payments are floating costs. Costs that will be paid to issue securities. These are floating costs. So floating costs will affect the cost of capital. We'll discuss about that. Let's see the cost of capital. We have seen source of finance. What do you mean by common stock, preferred stock, hybrid securities, and the likes. And let's see how to estimate the cost. First, let's see the cost of debt. The cost of debt. That means if we issue bond, we have to pay interest. That interest is cost for our company. And that interest is return for the investor or the bondholder. So required rate of return for creditor. The interest is required rate of return for the creditor. For example, suppose that the company issues bond with a before tax cost of 10%. Since interest payments are tax deductible, that means for our company or for the issuer, if there is interest payment, interest will be deducted from taxable income. So the amount of tax that our company is going to pay will be minimized. So the cash will be returned and will be distributed to shareholders. So it has advantage, tax advantage. So the true cost of the debt is not the raw figure. It's not 10%, that means, because there is tax advantage. The company will pay 10% on loan, but for that at interest, the company will save tax payment. So the actual or the true cost of debt is the after-tax cost of debt. The after-tax cost of debt is simply cost of debt times 1 minus tax rate. The after-tax cost of debt. For example, if the corporate tax rate is 40%, so what is the true cost of this debt then? The company is paying 10%, but there is 40% corporate tax. Since interest is tax deductible, the true cost of debt is the after-tax one, or 10% times 1 minus 0.4. So the true cost of debt is 6%. Is that clear? Is that clear? Do you have any question?
No. Can you say it again?
Which one?
This is the cost of debt. I couldn't understand this. The concept, yeah.
Cost of debt means interest that will be paid by our company. For example, if you have a bank loan from the bank, if you are paying 10% on that loan. This is cost for your company. But at the time of paying tax, interest will be treated as expense. So you'll deduct the interest amount from the taxable income. So there is saving for your company. So the true cost of debt is not this 10%. You are paying 10% for bank loan, for example, but your corporate tax rate is 40%. Since you are deducting your interest paid from the taxable income, the true cost of debt is this 10% times 1 minus tax rate. Tax saving is here. You are paying 10% for the investor, but you are saving 4% because of that from your tax. Am I clear?
Yeah, understanding.
Okay, so as a manager, do not simply see the raw figure of this interest. This is not your cost. Your cost of debt is the after-tax cost of debt. And let's see how to calculate the cost of preferred share. Cost of preferred share. We have seen the characteristics of preferred share. Fixed dividend is there. So the cost of preferred share is dividend divided by market price. Dividend divided by market price, this one, minus floating cost. Minus floating cost. This is the cost of preferred share. Dividend for preferred share divided by market price of that share minus floating cost. Now, because if there is floating cost, it will increase the cost of preferred share. Will increase the cost of preferred share. Let's see it by using an example. For example, if you can issue preferred stock with a market price of 45. The market price is 45. The floating cost is 3 per share. And for net price, that means market price minus floating cost is 42. 45 minus 3, 42. And if the preferred stock pays 5 dividend, what is the cost of the preferred stock? What is the cost? I'm waiting for you.
Okay. 0.1.
Okay. Because the formula is simple and straightforward. Dividend divided by market price minus floating cost. The dividend is 5. The market price is 45. Floating cost is 3. So simply 5 over
minus
42.
5 minus.
So this is the cost of your preferred stock. Cost of preferred share. Preferred dividend divided by market price minus floating cost. So we have seen cost of debt and cost of preferred share. Another source of finance is equity finance. If you have any question before this, you can ask.
Yes, sir.
Okay.
Then we determine 11 point something of the preferred stock cost. What does that mean then?
What does that mean?
Yeah.
Every source of finance has its own cost.
Yeah, the purpose of determining the cost?
Because it is related to firm value. We'll talk about that.
Okay.
At the time of accessing finance, for example, at the time of choosing debt financing, you have to know that debt has its own cost. You have to pay interest. Preferred share has its own cost. You have to pay dividend. Common share has its own cost in the company side. Assume yourself as a manager, and your source of finance will have its own cost. And the cost of source of finance will affect your ultimate objective, that is firm value. It's related to firm value. We'll talk about that. Am I clear?
So it will help us for alternatives. For instance, if I have an alternative.
For example, have you been in our previous class, capital budgeting decision? Capital budgeting decision. For example, for capital budgeting decision, you can compare some of the results with your cost of capital.
Yeah. Yes.
Cost of capital. So you can use this cost of capital in different areas of decisions. And you have to be able to minimize your cost of capital to maximize wealth of shareholders. So cost of capital can be used as a minimum return expected from any investment.
Okay.
A minimum return. And to maximize your shareholders' wealth, you have to be able to minimize the cost of capital. To minimize the cost of capital, you have to know the cost of each source of finance. Am I clear?
Yes, it's clear, sir. Thank you.
So it's critical to know the cost of each source of finance. You have another question? So let's see equity financing. Equity financing. When we say equity financing, we are referring common equity and internal common equity and external common equity. Before directly moving to calculation of the cost, internal common equity means retained earnings. Usually companies retain some portion from their annual income. For example, if their annual income is, let's say, 40% per share, earning per share. This is common in banks, for example. If their annual earning is 40% or 40% per share, some portion will be paid in the form of dividend. Some portion will be retained. For example, if earning per share is 40 earning per share. If, let's say, 30 per share is paid in the form of dividend, the remaining balance is 10. 10 will be added to retained earning. And that is internal source of finance for companies. They generate income and they can use that income as a source of finance. Internal common equity. Amount of income retained in the business, retained earning. External equity, issuing new share. Companies can sell new share to external parties. So both this internal and external common equities are source of finance for companies. And internal or retained earning and issuing new shares will have different costs. Let's see how to calculate cost of retained earning and issuing of common stock. Cost of common equity or retained earning, that means internal source of finance. Management should retain earnings only if they can earn as much as stockholders' next best investment opportunity for the same risk. That means you as a manager, you are agents for shareholders. And annually, some portion will be retained in the business. And we have to retain that money if we are sure about the profitability of that money. By retaining that money, we can invest it and we can generate additional income and we can maximize shareholders' wealth. Otherwise, if shareholders can invest that money in other area and generate additional income, we should not retain that money in the company. So we have to be careful. We have to retain more if we are sure that investors can gain more by retaining that amount of money in the company. And the cost of common equity is the opportunity cost of shareholders' fund, common shareholders' fund. And there are two methods. Actually, this is the advanced one. Probably if there is another course, portfolio management, we'll say this. Dividend growth model and capital asset pricing model. These are two models to calculate the cost of common equity. This is a formula. The cost of common equity, the cost of internal common equity or retained earning. The cost of common equity, D1 over P0 plus gross. Gross is here. So this case stands for internal common equity. D1 stands for the next dividend to be paid. The next dividend. P0 stands for the current market price of the stock. G stands for the projected rate of growth of the company. Growth of the company. So D1 over P0 plus gross. This is the formula to calculate cost of internal common equity or cost of retained earnings. Dividends that will be paid in the next period divided by current price of the share plus gross. So let's see it by using an example. For example, the market price or P0 of the share of common stock is 60. And the prior dividend or D0, the prior dividend is 3. And the expected growth rate is 10%. Look, here D0 is given, prior dividend. The formula is D1, dividend in the coming period. So dividend in the coming period is D0 plus D0 times gross. D0 times gross is D1. For example, in this case, the previous dividend is 3 per share. The growth rate is 10. That means D1, dividend in the coming period, will increase by 10%. So D1 is 3.3%. Is that clear? Dividend in the coming period is 3.3%. Are you with me?
Yes, doctor.
Okay.
Yes.
Okay, let's continue. For example, this is given. Sorry. So what is the cost of retained earning in this case? Can you calculate it? So D1 over P0 plus gross. It's simple. D1 is 3.3. P0 is 60. Gross is 10%. So the cost
Yes.
of
65.
that means 15.5%.
0.65.
0.156 or 15.5%. Is that clear? Okay, so we have seen cost of internal common equity, or in other words, retained earning. Let's see cost of external equity or new common stock. The difference between internal common equity and external common equity is only the floating cost. Floating cost. If the company is retaining its own profit, there is no floating cost. There is no payment for legal service. There is no payment for regulatory bodies to issue securities if it is internal. But if it is to sell new shares, there is floating cost. So this is the difference between internal source of common stock, internal common stock, and external common stock. Otherwise, the formula is the same. So for example, if additional shares are issued at floating cost of 12% of price per share, assume D0 is 3 and estimated growth is 10% and price is 60, the previous example. The only exception is the presence of floating cost, 12. So in this case, the floating cost, it is 12% of price, 12% of 60. So 12% of 60 is 7.2. So the formula is, the D1 3.3 over price 60 minus floating cost 7.2 plus gross 0.1. This or 60 minus 72 is 52. 7.2 is 52.8. So cost of the new equity is 3.3 over 52.8 plus 10%. So it will be 16.25. It is increasing. The formula is the same. The sharing price of the shares, the dividends are the same, but the cost of external equity is 16.25%, but the cost of internal equity is 15.5%. What is the reason for this difference? What is the reason for this difference? For internal equity, 15.5. For external equity, 16.25.
The existence of the floating cost.
The existence of floating cost, that's great. But you as a manager should not be interested on individual costs. Rather, you have to see your weighted average cost of capital as a base for decision making. Weighted average cost of capital. For example, these are the costs that we have calculated. Cost of bond, 66%. Cost of preferred share, 11.9. Common stocks, return earning and new share. Return earning 15.5. New share 16.25. These are costs, individual costs. Then we used 40% corporate tax rate. You as a manager must know your weighted average cost of capital. Individual costs are not enough to use them as a base for your decision, because your source of finance will be different. Maybe you will have both. You may have both, bond, preferred share, retained earning, new shares. So you have to calculate the weighted average. The weighted average cost of capital is simply sum of weight times cost. For example, if there is weight of debt, weight is simply means percentage of the source of finance from the total asset or the total source of finance. But let me give you a simple example. For example, if you have 10,000 debt and assume return earning 20,000 and assume external equity, assume 70,000. 700. So what is the total? The total source of finance for your company, 10 plus 20 plus 70. That means 100,000. The weight of debt from this 100,000 is weight of debt. What is the weight of debt? The weight of debt, the weight of equity.
%10.
10%. 10,000 divided by 100,000. Weight of retained earning, 20 times 20,000 divided by 100,000, 20%. This is what we call it weight. So weighted average cost of capital is weight of debt times cost of debt, if there is debt, plus weight of preferred stock times cost of preferred stock, weight of common share times cost. Sum of this weight times cost is the weighted average cost of capital. Let's see it by using an example. You may have different the difference between, for example, internal equity. Maybe you'll have external equity. The procedure is the same. Let's assume that LBC's desired capital structure is 40% debt, 10% preferred, and 50% common equity. So total 100%. So assume the costs are calculated above. The cost of debt is 6%. The cost of preferred share is 11.9. The cost of internal equity is 15.5. So the weighted average cost of capital is sum of weight times cost. Weight of debt is 40%. It is given. 40% times 6, 2.4. Weight of preferred share is 10%. 10% times the cost is 11.9, 1.19. Cost of internal equity, the weight is given 50%. The cost is calculated 15.5. So 0.5 times 15.5, 7.75. So the weighted average cost of capital is 11.34. So you as a manager must use your weighted average cost of capital as a base for your decision. And you as a manager must try to minimize the weighted average cost of capital. So this is a procedure to calculate weighted average cost of capital. Once you calculate the cost of capital and the weight, it is simple to calculate weighted average cost of capital. And the capital structure must be given. In this case, for example, there are three. For debt, preferred share, and common equity. Internal common equity is given. For example, the capital structure is debt, preferred share, and external common equity. The external in this case, assume the weight is 50, the cost is calculated 16.25. So the weighted average cost of capital is 11.75. So you have to know our capital structure, and you have to know individual costs, individual source of finance costs. After that, it's simple to calculate weighted average cost of capital. Is that clear? Do you have any question? If you have any question.
Yes, sir.
Okay.
But most of the times in our countries, a capital will not be raised through debt. It's mostly in common stock.
Okay.
Can we get a practical case that can be mentioned in our country? Those a company or any share company or any company that finance its capital through debt?
Yes, bank loan is common in our country.
For a capital purpose or for other?
Source of finance. Capital structure means it's a source of finance for companies. They sell shares after establishment. For example, if it's a manufacturing company, after establishment, they access finance from law, bank loan.
Okay.
Bank loan is debt financing. So it is common practice. But the only thing is bond is not allowed in other securities. But in the near future, it will be. Okay, Mohammed?
Okay, I thought this calculation was only for capital, but it's for all financing.
What do you mean by that?
Yeah.
Actually, we'll have detailed discussion about capital structure and financial structure. Okay. But if you have already read the chapter, there is difference between financial structure and capital structure. Financial structure, all sorts of finance, including the short-term financing sources. Capital structure, when the term capital refers the long-term nature of the source of finance.
Yes.
So issues that we have seen, common stock, preferred stock, internal equities, both are long-term source of finance for companies. Am I right? If your question is, we are calculating the cost for all sorts of finance, while capital structure is long-term source of finance. Was your question like this?
Now I have understand that. Okay. We are calculating the cost of finance of a company.
long-term.
But previously, I assumed that I was limited myself to the cost of only to the amount of capital that a company raised.
Okay. So don't get confused. Capital refers to all sorts of finance, not only finance from owners.
Okay. Okay.
Both debt and equity.
Thank you.
Okay. If you have another question.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
If you have another issue that you have to know is once you know your cost of capital, your cost of capital, to minimize or to decide another source of finance, you have to see the marginal one, the additional cost. For example, your weighted average cost of capital is, for example, 11% If you need additional source of finance, you have to see the marginal or additional cost. If the marginal cost of capital is high, you have to be careful. Mohammed, you have asked a question. What is the practical meaning of 11.7% cost of capital? Is there anyone who can answer this? What is the practical meaning of this 11.72%? Is there anyone who can try this?
On average, the company is costing 11.27% of costs from all debts, preferred stock, and from the cost of ordinary capital or equity capital.
Okay, thank you. All right. So this simply means if you have a project, if there is a project, we have seen capital budgeting decision. If you have a new project, after deciding that project or after selecting a project, the next step is the source of finance for that project. For example, if that project requires 100 million birr, you have to access finance for that. You have to access this 100 million birr for that project. For the source of finance will cost you 11.72%. So the amount of profit expected from that project must be greater than this one. Mohammed, are you there?
Yes.
If your investment requires 100 million birr, to access or to get this 100 million birr, it will cost the company 11.72%. Or 11 something million birr is the cost of financing that project. So that project must generate income greater than this 11.72%. Is that clear?
Is it annually or normally?
This is annual because this cost, dividend is annual, interest is annual, so it is annual cost. And when we talk about return, we're talking about annual return. Or in other words, this simply means for accessing finance. That means because of borrowing money from bank or by selling securities, there is payment for those. There is payment, for example, for debt financing. There is payment for equity financiers. So the company must pay 11.72 because of using others' money. others finance. So the project must generate a return greater than the cost of financing that project. So practically, we can interpret costs like this. If your project is generating 11.72%, for example, assume your capital structure is like this, and the weighted average cost of capital is 11.72%. If the project generates 11.72%, what does it mean?
We are operating on break-even.
We are operating on break-even. So we are generating income only to pay for these costs. Bills and securities, only the term difference. In the financial world, for example, government treasury bills, short-term securities referred as bills. But when you see securities, the term security refers to both debt security and equity security. We can use security to refer all types of instruments. Allow me to speak in Amharic. Security የሚለው ጀነሪክ ጠቅለል ያለ ስም ነው። ኮመን ስቶኩንም ፕሪፈርድ ስቶኩንም ቦንዱንም የግምጃ ቤት ሰነዱንም ሴኩሪቲ ብለን እንጠራዋለን። ስለዚህ ስሙ ደምስ የጠየቀው ስሙን ስፔሲፊካሊ ቢል ማለት ትሬጀሪ ቢል የምንለው የመንግስት የግምጃ ቤት ሰነድን ትሬጀሪ ቢል እንለዋለን። ሴኩሪቲ የሚለው ተርም ግን ሁሉንም ሊያጠቃልልን ይችላል። All types of instruments can be referred as securities, including a bond. So better to know the specific types of securities. Like better to know what do you mean by common stock, what do you mean by preferred stock, what do you mean by bond, what do you mean by treasury bills and the likes. Mohammed, 11.72% of what? 11.72% of your total investment or your total finance.
Doctor, can I come in for?
Yes.
Can I come in? I
Yes.
mean, my understanding in this 11.72% cost of the capital was like in our revenue, the total from the total. We have to pay 11.72 for the cost of capital. Does it mean like that? From our revenue, I mean annual revenue. From all our sales, we have to pay this amount for the cost of capital. Does it mean like that?
You can interpret like that. Relate this with project. You are establishing a new company. Assume that. You are establishing a new company, a manufacturing company, for example. If that manufacturing company requires 100 million birr. The source of finance may be bank loan, maybe issuing securities, common stock. For bank loan, you have to pay interest, right? That is cost for your company. For as a result of issuing common stock, you have to pay dividend. So if you access finance 100 million, annually, you have to pay 1.72%. That means from your net profit, 11.72% belongs to the cost of financing your project or your company. So you can interpret like that. From your annual income, 11.72 belongs to the source of finance or the cost of financing. You have to pay for a bank. You have to pay for other investors in the form of dividend or others.
But it is
Okay,
only finance cost. Yes.
Sorry.
Doctor, sorry. But it's only for financing. It's only finance cost.
Yes, financing cost.
It's only finance cost. Yeah.
Yes. So we have another question. Okay. So as a manager, you have to be curious on the marginal cost of capital. Now, if you are planning additional source of finance, you have to know the marginal cost, additional cost of capital. So we have seen source of finance, we have seen how to calculate their cost. The next issue is capital structure. Capital structure. Capital structure, it simply means mix of different securities. So we are using the term securities to refer all types of securities, bonds, preferred share, common share, and others. So capital structure refers to the mix of different securities issued by the company. And these securities include bond, bank loan, ordinary share or common share, preferred share, hybrid securities, warrant, convertibles, all types of securities. So the previous question, security refers to all types of instruments. So the mix refers to capital structure. And there are usually confusions regarding capital structure and financial structure. I hope you're familiar with basic accounting. Am I right? Do you know what do you mean by a balance sheet or statement of financial position is? What is a balance sheet? Is there anyone who can answer this? What is a balance sheet?
A balance sheet is a report which comprises assets, liabilities, and capital.
Yes, assets, liabilities, equities. So assets, all resources owned by the company having future benefit. Liabilities, obligations of the company. And capital, debt, and equity capital is here. So as I've said previously, the basic accounting equation is asset equals with liability plus equity. Asset equals with liability plus equity. So the balance sheet will be prepared in this format. So this side shows the source of finance. For example, liabilities. There are current liabilities and there are long-term liabilities. And there's also ordinary share. So these are all sources of finance for companies. All sources of finance, current liabilities, debt, preferred share, ordinary share, these are all sources of finance. All sources of finance for a company can be referred as financial structure. Financial structure. But this one, debt, preferred share, and ordinary share, or excluding these current liabilities. Because current liabilities are obligations of a company that will be paid within a short period of time. So the long-term source of finance can be referred as capital structure. So this is the difference between capital structure and financial structure. But sometimes some scholars use these terms interchangeably, financial structure, capital structure. But capital structure excludes short-term source of finance for companies. So we have to balance the long-term source of finance for our companies, capital structure. From our total long-term source of finance, how much from debit, preferred share, ordinary share, or common share. The mix between this can be referred as capital structure. And why should we care about capital structure? Because by altering capital structure, firms have opportunity to change their cost of capital and therefore maximize market value of the firm. So we have to know and we have to be careful about our capital structure because capital structure affects the cost of capital. And the cost of capital in turn affects the firm value, which is our ultimate objective as a manager, maximizing wealth. So to maximize wealth, we have to minimize cost of capital. To minimize the cost of capital, we have to know issues in the capital structure. So what is the optimal capital structure? How much from debt and equity? What is the optimal one? It is not clearly known. But simply, the optimal capital structure is the one that minimizes firm's cost of capital and thus maximizes firm value. What is that mix? We don't know. And there are different theories. different theories say different things. We'll see those theories. Now the cost of capital, each source of financing has different costs. For example, debt, preferred share, common share, internal equity has their own cost and different cost. So in analyzing capital structure, we look at weighted average one, the weighted average cost of capital. So the capital structure affects the cost. The capital structure affects the weighted average cost of capital. The weighted average cost of capital affects firm value. So we have to be careful at the time of maintaining our capital structure. And there are different theories say different things. And known theories, Modigliani, I think, Franco Modigliani and Merton Miller, there are 3 propositions. By the way, both are Nobel Prize winners in financial economics. With zero tax, corporate tax, and personal tax assumptions. In the first theory, they assume that there is no tax, zero tax. But practically, as you may know, corporations have 2 types of taxes, or there is double taxation in corporations. What are those 2 taxes on a corporation? Is there anyone who can answer this? If you invest in a corporation, there is double taxation.
Yeah.
What are those taxes?
Profit tax and income tax.
Profit tax and
Dividend tax.
Income tax. That means corporate tax and tax on dividend, personal tax.
On dividend, personal.
On dividend, there must be tax payment. First, as a corporation, there is, I think in our country, it's 30%, if I'm not mistaken. Corporate tax is here. After that, when shareholders receive dividends, they have to pay tax. And in some countries, in having well-established financial market, there is also capital gain tax. If there is value appreciation and if there is sales, if shareholders sell their shares, there will be capital gain tax. So there is double taxation in corporations. But assume zero tax first and corporate tax only, disregarding personal tax, and considering both corporate and personal tax. And what is the proper mix? That means which source of finance is appropriate? Is that debt or equity? Different propositions have different conclusions. We'll discuss about this. There's also trade-off theory, signaling theory, pecking order theory, and window of opportunity. These are capital structure theories that we will see this here. Riglani and Miller, usually the first letter of the name of authors, theory. The first proposition is zero tax. They assume zero tax. Assuming zero tax, they are going to justify the appropriate source of finance that will minimize cost of capital and maximize firm value. And the two firms. One is unlevered firm, the other is levered firm. Unlevered firm means firm without a liability. That means there is no debt financing in that firm. There is no debt financing. Levered firm, a firm with debt financing. Or in Amharic, ብድር ያለበትና የሌለበት ብለን እንውሰደው. And I hope you are familiar with income statement. EBIT refers to earning before interest and tax. Earning before interest and tax minus interest, because there is no tax, will give us net income, because they assume that there is no tax. So this is partial income statement. Partial income statement. If the firm is unlevered, there is earning before interest and tax, that is 3,000. If it is unlevered, if there is no liability, there is no interest payment. So EBIT and the net income will be equal. This one and this one. If it is levered firm, assume earning before interest and the tax is 3,000. Because there is liability, assume interest is 1,200. So net income is 1,800. Net income, earning before interest and tax minus interest. In both cases, there is no tax. And they try to say the cash flow to investors. For example, for the unlevered firm, the net income is 3,000. And cash flow to shareholders. Shareholders will receive 3,000. They also assume that there is no growth, so there is no return earning. So shareholders will receive 3,000. Shareholders will receive 3,000. And in the second case, in the second firm, levered firm case, a firm with a liability, shareholders will receive the net income 1,800. Debt holders will receive 1,200. The total amount of cash flow, both are investors. Both shareholders and debt holders are investors. So the total cash flow is 3,000. So cash flow of levered firm and cash flow of unlevered firm is the same. And their argument is, if cash flow of firms is the same, the value of the firm will be the same. So capital structure is irrelevant. So the appropriate capital structure, or the appropriate mix between debt financing and equity financing is not limited. We can use 100% equity financing and 0% debt financing, or vice versa. It is possible. According to this theory, the first proposition of MM, capital structure decision is irrelevant. No need to care about the source of finance. Whatever the source of finance is, the cash flow will be the same. Firms with the same cash flow will have the same value. This is their main argument. Am I clear? Is it clear? Are you with me?
Yes, we are.
So the conclusion is capital structure is irrelevant. Capital structure is irrelevant because firms will have the same cash flow for investors. Firms with similar cash flow will have the same value. So it has some assumptions. You have to know those assumptions. There is no brokerage cost, there is no tax, no bankruptcy cost. That means if there is increase in debt financing, the probability of bankruptcy will be high. The company will face a difficulty to repay borrowed fund with interest. So there will be bankruptcy. But they assume that there is no bankruptcy cost, and they assume that investors can borrow and lend at the same rate as corporations, and all investors have the same information. There is no information asymmetry. They have these assumptions, and other theories took one of these assumptions and try to expand this theory. We'll see that. But assuming this, and assuming that EBIT is not affected by the use of debt, MM argues that value of levered firm and value of unlevered firm is the same. VL equals with VU. Firms having debt financing, debt and equity financing, firms having only equity financing, their value is the same. So capital structure is irrelevant. Capital structure is irrelevant. And they argue that it is simply sharing the pie, assuming the pie as the firm's cash flow. The pie is the same for both debt, unlevered firm and levered firm. And it is simply dividing that pie. The size of the pie is the same. So whether debt financing is higher than equity financing or equity financing is higher than debt financing, the total value of the firm is the same. The total value of the firm is the same. So the first proposition is capital structure is irrelevant. In the second proposition, because in many countries tax is unavoidable, so there is corporate tax, and they try to entertain this corporate tax. In their assumption, one of their assumptions, the absence of tax is extended if there is corporate tax. So corporate tax is there, but if there is corporate tax, tax law allows interest to be deducted. If it is equity finance, if it is by selling share, dividend is not deductible from taxable income. But if it is financed from debt, interest will be deducted from taxable income. So debt will reduce the tax paid by levered firms. Therefore, more cash flow goes to investors and less to tax. So the cash flow for investors will increase if the firm is levered. If there is liability, that means. In other words, the debt shields some of the firm's cash flow from tax. So there is interest tax shield. So more cash will be available for investors if there is debt financing. Now they argue that cash flow of levered firm or firm with liability is higher than cash flow of unlevered firm. Cash flow of levered firm will be equal with cash flow of unlevered plus interest tax shield. Interest tax shield, or simply cash flow of levered firm is greater than cash flow of unlevered firm. Cash flow of levered firm is greater than cash flow of unlevered firm because in a levered firm case there is interest tax shield. Interest is deductible from taxable income, so some cash will be shielded by that. So the value of the levered firm will equal the value of unlevered firm plus interest tax shield. And interest tax shield is simply tax rate times the amount of debt. So this is their argument. So therefore value of levered firm will equal this value of unlevered firm plus tax rate times total debt. This is the tax shield. So that means the value of levered firm is greater than the value of unlevered firm. Let's see it by using an example. For example, earning before interest and tax 25 million, tax rate 35%, debt 75 million, and cost of debt 9%, and unlevered cost of capital is 12%. So value of unlevered firm, that means this one only. There is no debt. There is no debt. There is tax. Okay, there is tax. In this case, there is tax. So the value of unlevered firm is EBIT minus times 1 minus tax rate. So the after tax EBIT, because there is tax, divided by the unlevered cost of capital will give us the value. We are calculating the value of this EBIT. That means we are assuming that the income is 12% of the total value. So this is 12% of the total value. So the total value is 135.42 million. If it is levered firm, look, value of levered firm equals with value of unlevered firm plus interest tax shield, TD. So this is the value of unlevered firm. The value of unlevered firm. So this value plus debt 75 million times interest. So the value of the levered firm will be 161.67%. So the value of levered firm is greater than the value of unlevered firm. So which source of finance is preferable, debt or equity in this case? Which source of finance is preferable, debt or equity? What do you think? Oh. Are you with me?
Yes. Yes, sir, but 75, the 75 is multiplied by 35. Why? It's 9%, yeah? The cost of debt?
It's not cost of debt. We're not talking about cost of debt. We're talking about interest tax shield. Interest tax shield. So this is the total value of interest tax shield. Interest will shield some portion of cash from tax. So more, because interest is deductible from taxable income, more cash will be available to shareholders.
Yeah.
Okay. So debt financing or levered firm means a firm having liability or debt financing. Unlevered firm means a firm having no debt financing or 100% equity financing, 100% financed from common stock, for example. So which financing source is preferable? Debt or common stock?
Debt financing.
Debt financing, because the firm value is higher in this case.
Yes.
So according to the second proposition of MM, that means if there is corporate tax, debt financing is preferable than equity financing. But in the first proposition, their conclusion was capital structure is irrelevant. In the second one, if there is corporate tax, debt financing is preferable because the value of the firm will increase if there is increase in debt financing. And you can calculate the equity value. Value of levered firm, a firm with liability, that means. So this is the value of equity. So under MM, the relationship between firm value and debt in the presence of corporate tax, if there is increase in debt, value will increase. Firm value will increase. But if it is unlevered firm, the value is constant because there is no increase in debt and there is no increase in value. So increase in debt will lead to increase in firm value. So the conclusion is the appropriate source of finance is 100% debt. This is their conclusion. And there is also the third proposition, if personal tax is added, and there are also other theories. We'll see this in our next class. This is enough for today. If you have any question, you can ask. Do you have any question? Okay, if you have no, I will send assignments to the representative. I think he will communicate with you. ልክላቸዋለሁ አሳይመንቶቹን ሼር ያደርጋቸዋል ግርማ። ጥያቄ ከሌለ ለዛሬ በቃናል። ሰላም ደም
ጥያቄ ጠይቅ ዶክተር።
ሰላም ደም
ዶክተር አንድ ጥያቄ እንትኖቹ እነዚህ ዲስከስ የምናደርጋቸው ኖርማል ነገሮች አብዛኛዎቹ እነዚህ ዲጂታል ከረንሲዎች አሉ እነዚህ ቨርቹዋል ከረንሲዎች በተለይ ከረንትሊ እሱን ነውና ትንሽ ኢንፍሉዌንስ ያደረገው ያለው በተለይ ኢንተርናሽናል ማርኬት ላይ እኛም ቢሆን እንዲሁ የክሪፕቶ ከረንሲ እንትኖችን ትንሽ ኢንትሮዲዩስ የምናደርግበት አጋጣሚዎች ሊገጥመን ይችላልና እዚህ ላይ ኦል ኢን ኦል ማለት ይችላል በተለይ ከቻፕተር 1 ጀምሮ ስለ ፋይናንሻል ማርኬትም ስናወራ ኢቭን ስለ ካሽ አዝ ኤ ኪንግ ትሪት አድርገን ስናወራ ጀስት እዚህ ላይ ኢንኮርፖሬት ያልሆነበትና ኢፌክትም ስላለው ነው ቴክኖሎጂካል ኢምፓክትም ስላለው ስፔሻሊ ኢን ተርምስ ኦፍ ታይም ቫልዩ ኦፍ ማኒም ስናወራ ኢን ተርምስ ኦፍ ሪስክ ስናወራ ቦንድም ስንል ለምሳሌ ቦንድን ሪፕሌስ የሚያደርግ ልክ እንደዛ አይነት ሴኩሪቲ ወይም ደግሞ ክሪፕቶ ከረንሲዎቹ የክሪፕቶ ማርኬት ላይ ያለው ኢምፓክት አለና ምናልባት ኔክስትም ሊሆን ይችላል ኦኬ ጀነራል የሆነ ከአካውንቲንግ አንፃር እንዴት እንደሚታይ የተወሰነ ነገር
ኦኬ ጥሩ እንትን ነው ግን ፋይናንስ ሰፊ ነው ባይዘይ ቅድም መጀመሪያ እንዳወራ ነው አሁን እዚህ ጋር በአንድ ቢዝነስ ኦርጋናይዜሽን ኮንቴክስት ኢንቨስትመንት ዲሲዥን የመጀመሪያው ነው የት ላይ ኢንቨስት እናደርግ ብሩን ከየት እናምጣው ከዛ በኋላ ትርፍ ካገኘን በኋላ እንዴት እናከፋፍለው ሚለው ላይ ፎከስ ስላደረግን ፋይናንስ ሰፊ ነው ፋይናንሻል ማርኬት አም ኖት ሹር ካሪኩለማችሁን አላየሁትም ለብቻ ኮርስ ሊኖር ይችላል ፋይናንሻል ማርኬት አስፈላጊ ከሆነ መጨረሻ አካባቢ we can talk about this እና ስፔሲፊካሊ ከዚህኛው ስኮፕ ወደ ማርኬቱ ስለሚጠጋ ነው ወደ ፋይናንሻል ማርኬቱ
እኔ የፈለኩት how accountants need to think in the financial way in the cryptocurrency ስለ ቢትኮይን እንዴት ማሰብ እንዳለባቸው ለማወቅ ነው መጨረሻ ላይ ትንሽ ትነግራለህ
ኦኬ
thank you doctor
question have a good night
Good night doctor
Thank you.